As most of you know, a tax regulation known as Section 24 was introduced in 2017, and it has been progressively getting into place since. But now is when residential landlords can see the full impact on the balance sheets. It removes the landlord right to deduct the mortgage interest and other finance costs from the rental income before calculating the tax liability. And it has been replaced for a tax credit of 20% based on the loan and mortgage interest. Let's see the impact that Section 24 has on a property with a only interest mortgage in place. The taxable cash flow is calculated by taking all the expenses that can be deducted from the rental income. In the past, before Section 24, we could deduct the only mortgage interest from the rental income. So we will have a taxable profit of £220. However, as we can no longer deduct the only mortgage interest, the taxable profit would be £470, even if this is not the real profit. Therefore, in a year, we have a taxable profit of £5,640 versus the £2,640 that we will have in the past. Here, I calculated the net profit that a residential landlord would have in the past with this specific property versus the nowadays net profit, taking in account two scenarios. In the first one, the landlord pays 20% of the personal income, and in the second one, the landlord pays 40% of the personal income. In the past, the net profit of a 20% taxpayer, after paying the 20% of the yearly taxable income, which is 528, would be 2,112 net profit. And the net profit for a 40% taxpayer, after paying the 40% of the taxable income, would be 1,584 in this case. Let's take a look how it works now. Without deducting the only interest mortgage, the taxable yearly income is 5,640. So 20% taxpayer would pay 1,128 in taxes, and a 40% taxpayer would pay 2,256. On the top of that, they both need to pay the mortgage, which is 3,000 per year. But the government gives them a 20% of interest relief, which is 600. So the net profit of a 20% taxpayer is exactly the same than in the past, but the net profit of a 40% taxpayer has been cut in 600. But doesn't mean that if you are a 20% taxpayer, the Section 24 does not affect you. The answer is yes, it does. And the reason is because your gross income has gone from 2,640 to 5,640 per property, which is nearly, well, not nearly, is more than double per property. So if we see the bigger picture, we can see how the Section 24 can push you very easily from being in the basic rate and paying 20% in taxes to be in the higher rate and pay 40% in taxes, or from 0% to 20%, or from 40% to 45%. So if you want to determine if Section 24 affects you, I recommend you to study the case with your accountant, and not only the current circumstances, but also your future financial plans. Because if you think about acquiring more properties, or it's likely that you have a salary raise, or you would expand your self-employed income of any way above 50,207 per year, you will go from 20% to 40%. Or you might think, even if I go to 40% taxpayer, the higher rate, I would be still okay, because even if my profit has been cut 600 per property, my numbers are still green. But this is the case with this specific property. In another cases, the numbers can go from green to red. Here we can see the numbers of a 10 properties portfolio that includes buy-to-lets and HMOs provided by the site group. In the first column, we can see the numbers before the Section 24. Then we can see 3 columns that represent the numbers during the transitional period. And the last column is how the numbers are right now with the Section 24 fully in place. So we can see that the net profit after tax per year in this specific portfolio was 19,600. Then during the transitional period, this number were getting down. And right now, if the owner of this portfolio wouldn't have done anything about it, he would be losing £2,550 per year.